Globally speaking, we notice an increasing fear for recession. If you look at recent new data and forward-looking indicators, indeed all of them point to a more sluggish global economy. For example, if you look at the growth figures for the Chinese economy in the second quarter of this year, with a growth figure of 6.2% on an annual basis, the Chinese economy is clearly growing more slowly compared to previous quarters, despite all the stimulus by the Chinese government, in particular after the trade conflict with the US. Other forward-looking indicators, for example sentiment indicators, also have quite negative news for us. For example, if you look at business sentiment indicators, in particular in the industry, we see that they remain extremely sluggish at this moment. There's no rebound yet. Moreover, consumer sentiment indicators are deteriorating as well, which is a new element and is of course adding to concerns that there might be a global recession upcoming. Now, in this kind of environment, people typically look in the direction of central banks to stimulate the economy again, like it happened after the financial crisis. Now, if we look at both major central banks, the Federal Reserve and the European Central Bank, they are indeed preparing in their communication and their forward guidance for more monetary stimulus. For the Federal Reserve, the financial markets even expect quite a lot of stimulus, probably too much. In our scenario, we expect that the Federal Reserve will cut interest rates twice in the short run, because in the longer run, especially next year, there will be upcoming US presidential elections, and in that period, typically the Federal Reserve prefers to avoid the political turmoil. For the European Central Bank, we don't expect any rate cuts yet, although, well, the probability that this will happen in the near future is increasing. Nevertheless, we do expect that the European Central Bank will stimulate the economy more, not by rate cuts, but by more quantitative easing. So hence the purchasing of, for example, government bonds are bonds by private companies. So therefore, both the Federal Reserve and the European Central Bank will provide an additional stimulus to the European and US economy, hopefully with global implications, global spillovers, and hence they may try to avoid an upcoming recession. One of the main risk factors for the global economy, and in particular for the European economy, remains the Brexit. With the upcoming elections of the president of the Tory party in the UK, we expect Boris Johnson to become the president of his party and moreover to become the next Prime Minister of the United Kingdom. Now, Boris Johnson announced already several times that he has nothing against a hard Brexit, a no-deal Brexit at the end of October of this year. So the scenario of a hard Brexit with damaging economic impact can no longer be excluded. Nevertheless, it's not yet our main scenario because there are several forces acting against such a hard Brexit. First of all, British businesses are clearly pointing to the fact that a hard Brexit would cause very substantial damage to the British economy. And this might be a very important voice in the public debate in the UK. Secondly, the British Parliament also indicated that it remains very much against a hard Brexit and that it prefers a deal with the European Union before leaving that European Union. And finally, there's of course a new composition for the main European institutions after the European parliamentary elections, and this may open the door for new negotiations between the United Kingdom and the European Union on their future relationship. Also on the trade war, there is some positive news. After the G20 summit in Osaka, President Trump and his Chinese colleague basically agreed to avoid further conflicts and to try to find a way out of the problems through negotiations. In particular, China and the US will start new trade and investment talks, hopefully leading to a deal to avoid further escalation in the trade conflict. Nevertheless, we do expect that trade conflicts and also the technology war, which has become part of this trade conflict, will last in the longer run. So protectionism will still be there for a while. Not only between China and the US, but in many places in the world. Nevertheless, it's good news in the short run, obviously, that the US and China are talking again. Also good news is a new trade agreement by the European Union, and namely a trade agreement with Mercosur in South America. The European Union hopes to boost trade between the European Union and South America by this new trade agreement, which is obviously a very positive signal in let's say, a global context of increasing protectionism. Hopefully this can give a boost in the longer run to both the European economy as well as the global economy. A new source of concern is Turkey. Recently, President Erdogan announced that he will replace the president of the Turkish Central Bank. He appointed in the meantime a new president, and this new president got immediately as task to reduce interest rates, to cut interest rates. Now, interest rates in Turkey have been increased substantially to fight the extremely high inflation rate. Now, by cutting rates, Erdogan hopes to stimulate the Turkish economy, but at the same time, this may create very substantial inflationary effects. So therefore, we expect that in the period ahead, the Turkish economy might face substantial turbulence again, and this turbulence obviously may have global implications, in particular for the European Union as an important trading partner of the Turkish economy. To summarize, there is an increasing fear for inflation, globally speaking. And in the first place, people are looking at central banks to stimulate the economy, to avoid or to soften the impact of such a recession period. We do expect that central banks will indeed, at least to some extent, try to stimulate the economy, but more fundamentally, we need good economic policy in all countries in the world in order to stimulate the economy and to bring growth back to a higher growth path for the longer run. In the meantime, there are lots of risk factors which are still around, including Brexit, the trade war, and now also Turkey, that may disturb this picture further. So hopefully we can avoid this recession. Otherwise, we have to be very cautious for the future. We remain cautiously optimistic for the near future, but we definitely watch all these risk factors very carefully.